If you're trying to grow your money, chances are you've heard of mutual funds and index funds. But which one is actually better for you? Here's the shocking truth. Choosing the wrong one could cost you thousands of dollars over your lifetime. In this video, I'll break down the key differences, the pros and cons, and by the end, you'll know exactly which one fits your financial journey. The wrong fund can cost you tens of thousands of dollars over time. So which is better, an index fund or a mutual fund? Hey, stay tuned, and I'll break it all down for you. What's up, everybody? It's me here. First of all, thank you so much for all the love and support you guys have shown me. It really means a lot. I just wanted to take a quick moment to say that I appreciate each and every one of you. Now back to the topic at hand. There are literally hundreds of thousands of different funds to choose from, and picking the right one can be tough. But in this video, we're going to discuss the main differences between index funds and mutual funds, so that you can decide which one is best for you. Let's get started. What are they? All right, let's start off by explaining what these two types of funds actually are, because I think that's the most important thing to understand. In the most basic terms, both index funds and mutual funds are simply baskets of stocks and/or bonds that allow you to own a small piece of many companies with just one investment. This allows for diversification with a single purchase, which helps lower risk. An index fund is referred to as a passive investment because there is no active management involved. An index fund manager doesn't try to pick individual stocks that will outperform the market. Instead, they simply mirror a market index, for example, the S&P 500. This means that if the S&P 500 goes up 10% over a year, then the index fund matching the S&P 500 would also aim to go up 10% that year. Index funds usually track a specific market sector like large-cap U.S. companies, international developed markets, or emerging markets. You can even find index funds that focus on specific styles of investing, such as growth or value investing. But the most common type of index fund that you will see is the S&P 500 Index Fund, which tracks the top 500 companies in the United States. Some examples of popular index funds include SPY, VOO, and IVV. A mutual fund is known as an active investment because the fund manager actively picks the stocks and/or bonds they believe will beat the market. A mutual fund might consist of stocks, bonds, or other assets like real estate or commodities, and a fund manager will buy and sell securities within the fund in an attempt to generate the highest returns possible for the investor. Some mutual funds specialize in certain areas of the market. For example, some mutual funds only invest in large-cap companies, while others only invest in small-cap companies. There are even mutual funds that only invest in bonds or in real estate, but just like index funds. You can also find mutual funds that focus on specific styles of investing, such as growth or value investing. Some examples of popular mutual funds include VUG, VIG, and VTIAX. Fees and costs. One of the biggest differences between index funds and mutual funds is the fees associated with each. The average fee for a mutual fund ranges anywhere from 0.5% to 1% or more annually. That might not seem like much, but over decades of investing, those fees can really add up. For example, if you have $100,000 invested in a mutual fund with a 1% fee, you would pay $1,000 per year in fees. If you invest for 40 years, you would end up paying $400,000 in fees alone. Yikes! On the other hand, index funds have much lower fees. Most index funds charge 0.5% or less, and many of them are even cheaper than that. Vanguard's famous VOO, for example, charges 0.03%. That's 99.97% less than the average mutual fund. So over decades of investing, the difference in fees can be enormous. For example, if you invested $100,000 in an index fund with a 0.03% fee, you would pay $3 per year in fees. Compare that to the $1,000 per year in fees that you would pay on the same amount invested in a mutual fund with a 1% fee. Again, over 40 years. You would end up paying $120,000 less in fees with the index fund. That's why it's always said that the most important factor when it comes to investment returns is the fees that you pay. Even a small difference in fees between a mutual fund and an index fund compounds into a huge difference over time. Performance? When you look at studies comparing mutual fund performance versus index fund performance over long periods of time, it's been found that index funds usually come out on top. Morningstar found that over a 15-year period, the median stock mutual fund only beat its benchmark index by about 1.2% annually. After accounting for fees, however, the average actively managed fund actually underperformed its benchmark by 1.2% after all those fees. Now, I know what you might be thinking. Surely some of the mutual funds beat the market by a lot, right? Well, yes, they do. But as the old saying goes, past performance is no guarantee of future results, so we can't rely on that. Plus, the actively managed funds that do outperform often have large minimum investments required, high fees, limited trading hours, or may not even be available to the public. On the other hand, index funds don't have any of these issues. They have low fees, require no minimum investments, and are available to everyone at any time. Another reason why index funds often outperform is simply human error. Many studies have found that active fund managers make mistakes just like you. And perhaps they become too greedy and buy stocks that are already overpriced, or maybe they panic and sell when they should hold. These kinds of mistakes are costly, and they affect mutual fund performance. Because index funds don't have the same pressure to beat the market, they're able to avoid these kinds of mistakes and generate better returns. Remember, index funds win in the long run. Risk and strategy. Now let's talk about risk and strategy. Both index funds and mutual funds diversify your money, which lowers risk. But mutual funds may take on more risk in an attempt to beat the market. An index fund simply mirrors the market. So if the market goes down, the index fund will go down in price too. Mutual funds, on the other hand, may invest in more volatile stocks in an attempt to generate higher returns. If those stocks go down in price, the mutual fund will also go down in price. However, if the stocks go up in price, the mutual fund may go up more. So while mutual funds do offer the potential for higher returns, they also carry more risk. Index funds are known for being steady and predictable. Over the long term, index funds usually outperform risky bets. That's why index funds are considered a good choice for long-term investors. Mutual funds, on the other hand, are suitable for short-term goals or for people who want more volatility in their portfolio. Which is best for you? It's the question I'm sure you've been waiting for. Which is best for you? Well, there's no one-size-fits-all answer to this question, but let me share my thoughts with you. Index funds are quite possibly the best invention since sliced bread. No, seriously, I believe index funds are a great option for most people because they are low-cost, simple, and have proven to be a great long-term investment. Index funds are also a good option for beginner investors because they require no maintenance. Once you buy an index fund, you don't need to check it often or make changes. They're extremely low cost, and those low costs ensure that more of your money goes toward your investments rather than someone else's pocket. As Warren Buffett once famously said, the first rule of investing is to protect your capital. The second rule of investing is to protect your capital. Index funds are a great way to do that. If you're looking for something a little more aggressive in your portfolio, mutual funds may be the way to go. If you want an active manager who is constantly working to beat the market, then a mutual fund may be right for you. Mutual funds can also help you get exposure to specific sectors of the market that you may not have access to otherwise. For example, there are mutual funds that specialize in emerging market investing or real estate investing. While it's true that mutual funds can offer some benefits over index funds, it's also true that they carry more risk. And remember, riskier investments usually mean lower returns. Which one will you choose? Let me know in the comments below. Which do you prefer, index funds or mutual funds? And with that being said, thank you so much for watching. Hope you enjoyed this video. If you did, please hit the like button and subscribe to The Wealthy Path. I post new videos every single week. Thank you so much, and until next time,